Welcome back. This is Tony Mascali, your Elliott Wave analyst, presenting video number 5 in the mastering of the Elliott Wave theory. In this video, I'm going to combine classical charting and Elliott Wave theory in an attempt to try and predict the exact next major top. For starters, I'm going to show you a technique that I sometimes employ to pick major tops. This can work on major bottoms as well. And this is a half-hourly chart of the E-mini futures. And what this technique entails is to find a short-term trend line, resistance line, and a long-term resistance line. And if the market hits the intersection of those two lines at the exact moment they're crossing, it's a high probability of a reversal. Think of what is a resistance line. It's basically a lineal resistance. Instead of it being horizontal, it's operating linearly, but it's still a force that the market has to deal with. It's a measure of an energy, and it's the peaking of that energy. You've got the short-term energy coming through from this line here, which started here. This 1, 2, 3. This is the fourth test up here. And it's coming through from here. It's had two tests there, another test there, and a test there. And that was the exact top of the market on the 12th of February this year, when the Dow peaked at 29,500 something. I'm going to show you this line is more important than what you may realise. If I just put this one there, and I'll change its colour now. I have it there just so it wouldn't be make it black. That's a half-hour chart. I'll zoom out to a 4-hourly so that we can see enough history and see what that line's about. That line began in April 2019, and it has chopped a couple of tails, but you can see there that it's a good line of fit. It's got 1, 2, 3, 4, and ultimately 5 tests at the top. Whenever you see a long-term resistance line coming into contact with one or more short-term lines, be on the lookout. If the market hits the intersection of those lines, it's a very powerful resistance and can predict the actual major turning point in the market. Let's have a look at breaking down all the price action since that peak. Those of you who have been watching my videos would be aware that I'm assigning a 70% probability that this top here, made on February 12th this year, was Super Cycle 3. And if I'm correct, that has enormous ramifications. That's an 88-year bull market that ended there. And if it's got to correct an 88-year bull market, I'm thinking that this market's going to be in a correction for 10 years or longer. And the initial part of the decline will last around 3 years, and could go as low as 4,000, where the long-term channel support comes in from the 1932 low, where it parallels the wave 1 and 3 with the wave 2 of the super cycle. From that high, we came down in wave 1, which is of a minor degree. We came up ABC for wave 2. You'll see there, I'll just blow that out so you can see it. Even though the ANC peaked at roughly the same level, those of you who have watched my earlier videos and know the real rules of the authentic Elliott Wave, that is not a flat correction. It's a zigzag. The zigzag or flat is determined by the position of the wave B, which is there well above the previous low. So in a flat correction, the wave B will fully retrace the wave A. So that's a zigzag. We come down here for wave 3, and I've got the wave 3 bottomed on the 12th of March. And then we went into a running flat correction. This happened in the GFC. I would have gone over that in the video number 3, exactly the same time. It's called a running flat correction. It's when the market is so bearish that the B wave actually goes to a new low and the C wave can't get back to the A. But you can see there that that was a clear 3-wave subdivision, so that can't be an impulse wave. That's why it's A, B, C, and it's a running flat correction. And that alternates with that 1, 2. And you also know that I'm big on channeling. Now this is minor wave degree. I don't expect the channels to work out all that well, but considering that's the channel for the target, that's 1, 2, and 3. So connecting 1 with 3, parallel with 2, gives you the approximate target for wave 4, and that came within about 80% of the width of that channel, which is very good for a minor degree, as good as you would expect. So there's no problem with that. Wave 5 bottomed on March 23rd in here. Looks like it made a double bottom, but that double bottom, it actually started wave 1 and 2 for a double bottom, and the double bottom came in on March 23rd, when the actual 5th wave bottomed on March 22nd, but it was a double bottom. And under Elliott Wave's rules, wave 2 can fully retrace wave 1. It's not allowed to more than fully retrace wave 1. And in this instance, I can see there from the low that it hasn't done so. So, counting up from there, we've got wave 1, 2, 3, 4, 5. Now this is a simple zigzag type correction. There's no double top in it. If we went down to an hourly chart, we'd probably be able to more clearly see. It would have come down to there, up to there, down to there. In any case, it's not a flat, so that'll be a zigzag. And that alternates with this, and this is an irregular B wave flat correction. A, B, C, the 1 and the 3 and the 2 and the 4. This is on a minuet wave degree, and it's actually channeled perfectly. You wouldn't expect that to happen all that often, but happy days that worked out that well. And then we come up here, and that's 5 waves for A. That's only A of a bigger A. And then we come down a 3-wave pattern for B. Because it's a B, we don't need to worry about alternation. There's no 2 and 4. And then we come up here. That'll actually be there. That'll be there. That'll go there. So when you change time frames in this package, it seems to move these away. So if you go from an intraday to a daily and go back to intraday, these will move just because the daily chart doesn't know which period you're on anymore. It confuses it. Okay. So 1, 2, 3, 4, and again I do my paralleling technique. 1 to 3, 2 parallels, and I get 4. So what's changed since video number 3 is that as more prices unfolded, I have revised my short-term wave count, but only my short-term wave count. I'm no longer counting wave C as a diagonal triangle. It doesn't make a big difference, but I'll just show you what the new count is. That's A, and now for the B wave, I've got an expanding triangle. The triangle goes A, B, C, D, E, and the pattern is the highs are through there, the lows are through there. It's got the right shape and the right kind of 3-wave. There doesn't look much impulsiveness in any of this. Maybe that might subdivide in 5, but everything else subdivides in 3. That's my preferred wave count here. That now gives you minor wave B for the ABC to complete intermediate wave 2. In the C wave, we've done what I believe is 1, 2, 3, 4, and we're just starting or about to launch the 5th wave of the C. So we're very close. If this wave count's correct, we are very close to ending this. Okay, what have we got? Let's have a look if we've got any identifiable resistance lines. Because I've been changing from half hourly to 4 hourly, these just seem to move off their spots a bit. That was originally positioned on that high there, and that high, yep, and yeah, that's pretty good. So it just missed there, but I'm expecting it to hit on the last test. I've also got a longer term line coming through, starting here, which starts here, intercepts that high, just misses that one, and if the market hits the intersection of those two resistance lines, which intersects on the 2nd of June in the afternoon, that would be a potential reversal point. Also, I'll show you that that coincides with a common target for wave C, and we'll stand back from this so you can see it all. A common target for wave C is 0.618 of wave A. So you see that purple marker there? That's measuring 0.618 of the height of that purple line there, which was the height of where I've labelled A. That comes in at about 26,290, which is pretty damn close to where those two lines intersect. There's a fair bit tying together there. What will you want to look out for if the market hits that? Since March, the volume has been relatively low. You'll see there that the volume has been trending down all the way through here, which is what's supposed to happen according to the volume principles that Ralph Elliott used. And the volume principles that Ralph Elliott used is that there should be a spike on the volume of the 5th wave, which there is, but the volume in the spike in the 5th wave should be less than the volume seen during the 3rd wave. You can see the 3rd wave had volumes up here, and then the 5th wave peaked at volume there. So I know that's a bit hard to see. I'll probably have to move that so you show. That's where the volume peaked for the 5th wave. So what's supposed to happen, according to Ralph Elliott, is that volume should pick up during the impulse waves, and it should recede through the corrections, which it did all through here, through this ABC pattern. Volume peaked here and it dropped off. Then it ramped up again for the final impulse wave. If volume exceeds what was seen in the 3rd wave, in the 5th wave, then it's a high probability that you don't have the 5th wave and you've got an extension on your hand and you're going to continue to new lows. That's not what happened here. I don't really like using Elliott wave theory on these minor wave counts. It's just that the principles don't conform as well as what they do on the major wave counts. A lot of you probably wouldn't pick up on this, but strictly speaking, that isn't a classical Elliott wave pattern. And that's because a classical Elliott wave pattern for a zigzag should be a 5-wave A, a corrective B, and a 5-wave C, or 5-3-5 pattern. What this actually is, it's a 3-5-5 pattern. But the triangle's fine for wave B. That's one of the corrective patterns. And it should be either a B or a 4th wave. So that's fine for the triangle to be located here. But the 3-wave A is not normal for a zigzag. But once you start getting into minor degrees and you start getting into waves that are not of important impulse, you're going to get slight deviations. And I think this is the reason why modern Elliott Wave theorists have developed all these different types of corrections like A, B, C, X, A, B, C, X, A, B, C. I might as well throw the alphabet in there. And this is what happens when you try and get into the intraday stuff. It does get tricky and it does get complicated. But having said that, there is almost as equally a valid count as placing. It doesn't make a big deal of difference, but you can place the A wave there, and then you get 1, 2, 3, 4, 5 for A, B, C for B, and it's still the same for C. It doesn't change the position of the B wave. The only thing that it changes is it makes the A wave longer, and that black line, if the A wave is the longer wave, then its target is up here, because you've got to measure, if you're marking A where I've now put it, if A is peaking there, then it started there, you've got to get that height and measure 0.61 out of that. Whereas if A finished where I first had it, which was here, then it'd be 0.618 of that. They're both valid counts. I like this one more than the other one. To put that there, I don't get a good channeling out of the 2 wave and the 4 wave. So that'll be the one if I do the count that way. And that's still not parallel. It's slightly more this way because that was moving it arithmetically. We're not on an arithmetic scale. I can see that it's probably about there. Okay, it's passable. If I was to show you that count, what I'll do is I'll take this one off for now. Otherwise it's just going to get too messy. I'm going to start there. And it's going to go 1, 2, 3, 4, 5 for A, B, C for B, 5 waves for C. I expect one of these lines at least to give us the peak. So if the market peaks on that steeper line, that puts it around the 10th of June. That's to make the higher target. I can easily imagine this thing edging and finally peaking up there, because it has been moving pretty slow. And see how the first wave, it started out pretty quick, and the third wave at a less steep trajectory. That often means the 5 is going to be even less steep. So it could be slow, but no guarantees. And 5th waves are never reliable. To be honest, it doesn't even need to go to a new high for this 5th. So that's minor, and that's minute. It's of a minute wave degree, this 5th wave. So you can't expect it to be perfect. It's a real long shot, just so you've got those levels. Those Fibonacci targets are 26,290, and this is the mini DOW futures that I'm plotting this on. This is the spot month continuation in the mini DOW, and the alternate target for the alternate wave A is 26,848, and that's up here. If you do see, by any chance, if you do see the market rocketing up through both these resistance lines, then obviously that's too strong to be ending here. And the other thing to consider is that there's another target here as well, and that is based on the wave 5 being equal to the wave 3. It looks like it's about 26,925 is where the wave 5 will be equal to the 3, and not in number of points, in percentage. Because you must know me by now, I don't work in arithmetic. See, if you have a look at that, the third wave is good as I'm going to blow it up so we can really see it. That's about as close as I can get it to the low. And see if I position it. Rest it right on the high. That's it there. And it says it's 6.98%. Now when I move it up to the bottom of wave 4, now it says that it's 6.73%. I never touched the length of that line. That's because this package is not designed to work in semi-log scale. What it's doing is it's measuring an equal arithmetic. So what I've got to do now is extend that to .98. That's about 9/6 of that close. I'm going to get it there. Just won't let me go there. It jumps in a few increments. So that's right on 26,800 as I just measured it then, which is about as good as I can get it on the chart. And without getting my calculator out and measuring exactly, but that's good enough. So 26,800. Now why is that important? I'll tell you why that's important. Because if it goes any higher than that, that count's invalidated. Does anyone know why? If you know the rules of Elliott Wave theory, wave 3 is normally the biggest wave in a 5-wave advance and can never be the smallest. It can be the second smallest. Well, they look the same size there, 1 and 3, but if you check 1, I can grab the line. See that? 9.03%. The wave 1 is actually bigger than wave 3 in percentage terms. So if it's bigger than wave 3 in percentage terms, that means the maximum wave 5 should be is the same percentage as wave 3. Otherwise it'll make wave 3 too small and then you can't count it. Well, it breaches one of Ralph Elliott's rules. If it's a slightly bigger, that's okay, but this is it. You don't have to worry about this when you get into bigger waves because the rules conform. Just so you know that's what you're looking at. And that's a valid target too. 26,800 is a valid target because wave 5 often does equal one of these other two impulse waves. And because it can't equal the 1, because the wave 1 was bigger than 3, then if it's going to equal one of them, it's going to equal the 3. So there's another target, 26,800. I've got about 3 targets coming in fairly close together there, 26,290, 26,800 and 26,848. It says there 802, 802 and 848. Well, they're pretty close together. You can virtually group them together, 800 to 848. Also be on the lookout that I believe that the market will hit and peak on one of these overhead resistance lines. If not, and if it hits the intersection of them, which you can hit on the 1st or 2nd of June, that's early next week, and we're on the weekend at the moment, so nothing's open, not even the after hour session's not trading at the moment. If it hits the intersection of those lines, and we're talking around in the 26,250 to 290 area, if you see the market hit that, what you want to look for is, you want to look for in the first hour, you want to see some volume that's higher than what you've been seeing in previous hours. And the more pronounced it is, the more convincing it'll be that some volume sellers have finally come in and taken this thing on. You just think about how many people would have capitulated and given up their long positions in all this high volume back there. And at some point, the way they're feeling is they wish they didn't sell, especially in the last wave down. They wish they didn't sell. If all the people that gave up their longs all come back in and try and buy the market, then there should be in theory, some even bigger sellers who didn't sell through there that will take them on. If I'm right, there's going to be a tsunami of sellers, not just one big seller. There's going to be a tsunami of sellers if I'm right. Because if this thing is ready to pop now, I'm looking for this thing to go straight through this low and the March 23rd low down at 18,000. I'm looking for the market to just clear those out and continue. Because I've got this on my favourite count as wave 1, intermediate of a 5 wave down for A of a primary wave of an ABC cycle in a triangle. You'll have to see my long-term count. This is just a short-term update. This is worth having a go with a tight stop. This is a 100 to 1 risk reward if this turns out to be right. If it doesn't, that's fine. We'll wait for another opportunity and I'll do another update when I think the time is right. Okay, good luck with your trading and investments, guys. I'm signing out for now. Okay, bye.